Good morning, guys, and welcome to the Camp Financial Stock Market Update. Today is Friday, June 16th. So I want to do something a little bit different today. Maybe we'll make Fridays kind of a look back day where we look at some of the stuff that we've either written about or different stocks that we've put into the portfolio that we've talked about here on the YouTube channel, whatever it may be. So, but yeah, I kind of want to do like a flashback Friday where we take a look back at previous trades. So with that, let's take a look first at some of the stocks that we've actually written about and published. You can go back and look at the dates on my webpage. They'll show you what I wrote, why I wrote it, what I was thinking. This is just going to be kind of a overview, highlight, whatever you want to call it. So with that, let's start first with one that was recently stopped out. It would have been stopped out. I don't have the date that it would have stopped out. So TOWR International Group, that's the auto parts manufacturer. So we originally wrote about this, about 100 shares at a limit price of 23 bucks on August 1st, 2016. That was when we published the article and said that would be one to go ahead and purchase that day. So 100 shares, 23 bucks, $2,300 invested. Reinvested the dividends since then. Whenever it paid a dividend, we would have just automatically reinvested it. So it would have accumulated another 1.189 shares. So you had just over 101 shares. The high that it got to was $29.05. Depending on where you look, there's some stuff that shows $30.50. But I try to use, when I look at highs, I try to go back and look at, not just what it says on Yahoo Finance or Google Finance, but I try to look at, where I've actually seen trades completed. And $29.05 was the most I saw. There was probably one that traded right at the open at $30.50, and then the stock came right down to $29.05. So anyway, so we used $29.05 as the high, which put our stop loss on that because we recommended a 20% stop loss, trailing stop. Was at $23.24 to stop out. So with that, we would have stopped out. It would have been, I believe it was earlier in June. It might have been in late May. But anyways, regardless, we would have stopped out there at $23.24. Collected another 11-cent dividend because it went ex-dividend in early May. Which would have got us out of the stock at 2,300. So total trade, you come back out at $2,362.76 minus the commissions. So you had 10 bucks in, depending on what broker you're using. A lot of them are offering $5 trades now. So you would have got back out with a $5 trade. So $15 in commissions. $2,347. So not a big gain. You got out with almost a 2%. So if you, without commissions, you're talking about 2.73% on the trade, and so we would have been about 10 months. So not great, not terrible. I mean, obviously that's why you put the stop loss in place, is to protect if the stock goes against you. So that's that one. Let's go back. We'll look at our oldest stock that we wrote about. That was Aflac. We wrote that article. That was back in November 18th, 2015 is when we wrote that article. And one of the recommendations that we had was to sell a $60 put option at that time at 55 cents a share for the January expiration. So in January it was below 60 bucks a share, so we would have had that put on us. So at 60 bucks a share minus the 55 cents a share that you collected for selling the put, so your buy price for 100 shares is $59.45, and that was January 15th, 2016. Since then, it's paid out 6 dividends, and the next one should be, I believe the next one's about ready, or it may have already, yes, it already paid out, sorry. I'm looking at it, it's a little confused here by my formula. So it's already paid out. The current value of, so your initial purchase is $5,945. That's currently at $8,063.43 with the dividends reinvested. So you're up 35.63% on that stock in 16 months. Pretty nice trade on that one. The high price that it's got to is $78.26. And our stop loss on that one, again with that trailing 20%, so the worst, even if this stock would turn around and go straight against you and just have, multiple terrible bad days in a row, you're still going to get out of this with at least a 10% gain. And one of the things that we've started to implement into our systems, and I haven't tracked it on this one yet, I need to, on this stock, we're not going to implement it, but on our other portfolios where we've been using it, once we've got a stock where we know we've got a guaranteed winner, so this one, TOWR Financial or TOWR International would have also fit this same bill. As soon as we know that we have a profitable trade, we start tightening that stop loss just a little bit. That way we're not giving back quite as much of the gain as we would if we just kept the standard stop loss. So now on to the other ones that we've written about. So Apple, we missed that one. My buy up to price, we read about this in February, was $125.23. At that time it was trading like $127. I wanted to see it come down just a little bit. I felt like if it could come down to 125.23, I'd be ready to pull the trigger. And obviously Apple went to 155. I think it's currently around 143, which was kind of my number. That's why I wanted to see the stock drop to 125, as I felt like Apple is currently a $145 stock, but we want to be able to get in at a price where we could generate at least a 20% return within the year. So it never got down there, so we're out. So we never got into that one. And now the last one that we wrote about, that's Alphabet, ticker symbol is GOOGL. Make sure you've got the difference between the A shares and the C shares. So we would have bought GOOGL at $841.31 a share. We do for this, we do everything based off of a round number. So if we're using 100 as our shares bought, just so that way it shows up the same, whether it's buying off of options or whether you're buying straight out of the market, just for simplicity's sake. That's why we're using 100 shares. Obviously, not everybody's going to have $85,000 to put into one stock. I don't. If I was actually buying Google, I'd have probably bought like 4 shares. That'd probably been about the most I would have wanted to put at risk in one trade. So, we're not working with large amounts of money yet, but that's what this is about. As you continue to grow it, then it makes it easier for you to start buying in those big round lot numbers. So anyways, with that, so the highest price Google's got to is $1,008.61. So it's pulled our stop loss up to almost, it's just a little below what we bought in at. So it's over $800 now is where the stop loss is at. Obviously it's trailed back off. It's at $960.18 currently, and we could see this, definitely see this turn back around, head back up and move into the profitable territory. So the worst this trade would do, if it continues to drop down and it would hit that stop loss, would be a loss of about 4%. So it would be 4.09% would be the loss on that. So that has all happened since February 17th, so less than 4 months. Currently it's up 14% in 4 months. So another nice solid trade. That's what it's about. It's not about hitting doubles and triples. I mean, sure, it'd be great to always buy a stock and have it go up 100% within the next year, but that's not very realistic for the most part. I mean, you're going to find some anomalies where you can take advantage of that, but that's not what investing in the stock market's about. It's about getting small gains, gains that are going to outpace inflation, gains that are going to outpace anywhere else you can invest. I mean, you can't invest in a bond and have it make 14% in 4 months, or for example Aflac, that's 16 months old. You're not going to get a bond that's going to pay 36% in 16 months. It's just not going to happen. Now TOWR, on the other side, 2.73% in almost a year. Yeah, you can get that kind of yield, but that's the difference of, if you buy a bond, that's what you're going to get. You're going to get 3%. You're going to get 4%. That's why stocks, equities are as important to your portfolio as they are, is because you can get these outsized gains where you can make 35% in 16 months. You can make some of the other ones we'll go over next Friday. I guess we'll jump into the other systems that I've been trading for my own account, but I'll definitely be using with new client accounts. As we start to build a client base, I'll go over the system in depth with all of my clients, let them know, this is how we trade this is why we do it this way, this is why this trades this way, and that sort of stuff, just so that they can, all my clients can look to capitalize on the same kind of profits that we're looking to make. So that is it for today though, guys. I hope that it kind of helps to go back through, do a rundown, do a little flashback of companies that we've written about, because I don't want people to just think that I'm going to toot my own horn for when I've done well. I want to be real here and let people know, hey, sometimes we're going to make pretty good gains, sometimes we're not. Next Friday, as we dig into some of the other systems, I'll probably start with my technical trading system that I talked about the other day, where we've had 21 full round trades, so purchase, sell, completed. I'll tell you right now, I'll do it real quick, see if I can make this calculation happen quickly. But So out of 21 completed trades, 7 of them were profitable. 14 of them were not profitable. That sounds pretty bad, right? What kind of stock picker only makes profits on 33% of their trades? Again, this is only one of the systems we use, but this is why that maybe that number necessarily shouldn't influence as much. So let's see. So we've got I was right. 7 profitable trades that have been closed out. The average profitable trade is a 36% gain. Okay. Now let's look at the negatives. We have 14 negative trades, or trades that, there's one more, I apologize, there we go. 14 negative trades, and the average loss on the negative trades is 16.27%. So, as you can see, we're making 36% on the ones that go good. We're losing 16% on average on the ones that go bad. So with those numbers, take a third, times 36%, which is 12%. You take 2/3 times 16%, which is a 10%. So still, overall, the portfolio, that's why that portfolio is traded profitably, is because the winners more than make up for the losers. And as I mentioned before, currently we've got 9 open trades, and 6 of those are already guaranteed to be profitable trades, with the average gain of those at 30.1%, and the average on the other trades are still up 7.8%, although they're not guaranteed profitable trades. The guaranteed numbers that we've got for the profitable trades are 11.4%, versus the negatives are gonna, if we would stop out, are gonna be an average of 6.8%. So that's why the system works. It's not foolproof by any means, but you know, that's why it makes money. So if you have any questions, feel free to send me an email, chrism@campfinancial.net. Otherwise, we will see you next time. Take care.